Hi everyone, this is Piyush. I'm the founder and managing partner of Prath Ventures, which is an early stage consumer fund.
Piyush, you are was from the same B school as me, and that's how we got connected. Tell me what you did once you were like passing out from MDI. Let's start your story from there.
Yeah, so I spent most of my time at MDI thinking about my first finance job. I had a finance career. I was the secretary of the finance club. I was teaching finance to most of my batchmates and my and the junior batch as well. I think at that point of time, private equity venture capital was very nascent, and banking was actually, even private banking was evolving, and the names like ICICI and at that point in time UTI and HDFC, these were kind of big names, and they used to come to campus. And I think that was my dream job. And then I came to know about First Global, which was an equity research firm which was to come. It was the first year that they were coming to our campus, and I set my sights on it. It was a very interesting campus. You know how it is campus. When I was in the interview, I was told I've been selected by two other firms, and if you don't get this, don't convert First Global, you have to come out and you have to choose one of the other two. And I was sure I didn't want the other two. And the interview was going well. I don't think it was going rocking, but Shankar, who was the founder of First Global, I was sent a chit inside, and Shankar said, "What is it?" And I told him what it was, and I said, "This is what I want to do." He said, "You have the job." And that's how I landed my first job at First Global. And so it was very, I think, first job at First Global, I think I could not have asked for a better start. It was a great ground for learning the basics of equities. Coincidentally, I started as a consumer analyst, and I'm now running a consumer fund. So yeah, in between did a lot of stuff. But
What was First Global? It was a public market investor.
First Global was a stockbroking firm. So it used
Okay.
to, I was a research analyst there, and my job as
Like
a
a
consumer
Motilal
research
Oswal
analyst.
and
Absolutely. As a research
it.
analyst, it was my job to cover the consumer sector, keep meeting those companies, and giving recommendations to investors.
Right. Got it. Okay. Okay.
Yeah,
Okay.
that's how it started. And
Hmm.
I think I had a lovely time there. The head of research used to be Devina, who was I met about gold medalist. She was a tough taskmaster, but learned a lot from them. A lot of basics of finance, which ideally should be taught in B schools or somewhere else, was taught to me in the job. And through that, I think I spent about a year and a half there. First Global ran into some trouble at that point of time, and I had to kind of change jobs immediately. And this was the time I got married as well. While First Global was not paying salaries for a few months, I moved to XM Bank of India. It was a very short stint, spent less than a year there. I think on day one I realized this is not a cultural match for me. But again, I had a great time there. The executive director there, Sridhar, took a liking, and he took me to projects that he was working on. It was great working with them again. Super learning early on in your career, working straight with the executive director, and kind of there were 3-4 different pet projects of his he was working on, and he would make sure that I was occupied enough on those. And then moved to ILFS. That's where I spent 3-4 years. And we were doing a bunch of stuff there. ILFS was on the financial services side. It used to be uh, kind of an NBFC, which was lending. So we used to manage a book of about 10,000 crores. We used to do investment banking for our clients, used to raise equity for them, and also used to do prop investing equity as well. So did a lot of that. That's where Hetal, he used to be the CEO of financial services business. He was starting up this fund, Tano Capital. And by then, I had spent having raised equity for some of our clients. I was really enamored by the private equity world. And he said, "I'm starting this private equity fund. And would you want to join?" And I said, "Yes." I don't think it took more than a few seconds for me to say yes. And this was early 2006, and I spent most of my career there. I spent a good 17 years there, and that's where I would say me as a professional got shaped. And so after that long journey of 17 years, and we can go into details.
I have a
Sure.
couple of questions on the
Yeah,
Tano
sure.
Capital. So, whom did you raise funds from?
So Tano Capital was actually the original founder was this gentleman called Chuck Johnson. He's from the family which owns Franklin Templeton worldwide,
Oh,
and he had set up Tano Capital to do an alternates platform. While there was a bit of family money also there, we also raised money from institutional investors, mostly outside India. So
okay.
they were guys from US, from Europe, and from Hong Kong, Singapore region who had come in, and we did two funds, and both were family money plus the institutional investors in these geographies.
And how much was the total amount raised?
So we managed about $210 million across two funds.
Okay.
This was so $1 million. We are used to talking $1 million, but yeah, the first one $100 million was 400 odd crores in size, and in terms of what we got deployable money. And the second fund, $110 million, was more than 600 crores. It was. So we managed this money for 2022 when I left. We were practically kind of done with that. We had exited most of our investments, just a
What
couple
was
of
the
which were
thesis?
valuable.
What kind of companies were you
So it's
acquiring?
very interesting. I think 2006, Akshay, there was so much of excitement around India. And we feel that today there is excitement and exuberance around India. It's nothing compared to what it was in 2006 7. India was believed to kind of really follow the China growth path. We believed most of the projections by leading economists or all equity research analysts were 8 to 10% GDP growth rates. And each sector was kind of showing on Excel sheets linear growth rates going unbelievably high. So I think somewhere we got swayed by that. And first one was kind of all over the place. We did almost everything. We said India, we are playing the India growth story, and hence that growth story plays across industrials, infrastructure, consumer, healthcare, financial services, and we did a bit of all of that. And not soon after 2006, 2008 and 9 happened, and there was the bubble that got burst, and especially around infra and industrials, we saw a lot of pain in the portfolio. Some of the industrial companies did well, but the infra companies, which had taken 30, 40% of the capital of the fund, did not return anything at all. The balance of the fund did well. We were able to, in context, 2006 was a bad venture B because of these same reasons. People got excited and did investments all over the place. But we returned kind of capital to our investors in dollar terms. And I think that is something that took a lot of effort to do, but not something on an absolute basis you're proud of. But when you see where your peers ended up with, this was a decent outcome. Also, it was a huge learning for us as an investment team. So as an investment team, when we had come together, we were five of us. We were there. Chuck, who was based out of the US, and there were four of us here. And while we had all been around equities, Hetal, before he was the CEO of ILFS, he used to lead ILFS private equity arm, VC private equity arm for 7, 8 years as a CEO. But other than him, no one was a full-time private equity professional. And I think we made a lot of first-time fund mistakes. And by the time we started thinking about our second fund, and I think market was kind of really they give us an opportunity for the second fund, despite our second first did not doing very well. And second fund was a very cohesive strategy of saying that, okay, where is it that markets are ready for institutional money? Because opportunities can be there across, and opportunities are both cyclical and structural. Where is the India structural opportunity? Where does it lie? And which pockets of those are ready for institutional money? And we decided three broad sectors: consumer, financial services, and healthcare pharma. And we wrote out a thesis around these three, and 95% of the fund got deployed across these three sectors. And just I think that, and because I think we learned from a lot of our mistakes from our first fund, second fund did far better, and we had successes across all of these sectors.
And so, private equity means you would have a significant stake, even a
Yes.
majority ownership, and you would be operationally hands-on in making sure that the business is delivering outcome.
Right. So, Akshay, several questions here. Let me take first is substantial stakes. Yes, almost everywhere we had stakes ranging from 15 to 30%.
Okay.
And so, by virtue of that, we would be having a lot of rights. We would, and these were substantial stakes. So, promoters would respect you. A lot of it would not just be driven by what your rights were. It was a natural respect. Somebody owning 25-30% of your company would kind of get that. We did not do majority transactions. I think we had the highest stake was about 40% plus in the company. We were not majority investors, but at the same time, we were very operationally hands-on. So I think that's where I personally learned the most. From very early on, I started getting involved in the companies, and it really helped. I think Tano as a platform allowed me to really come into my own in this way. And the more I got involved in the operations of the company, in their strategies, and getting involved not just on a very strategic level, but at operating level to try and understand what works, what doesn't work. There were certain areas over a period of time where we started working very deeply with them, and our ability to understand what works, what doesn't work, and hence our investment thesis, our selection also improved a lot with that. Right from first fund, there were several companies that, and there was a company which we had invested in, which made acquisition in Italy, and kind of, which was where 90% of the capital total deployed was in that company in Italy. And I started traveling to Italy very often. It used to be every alternate month, and it was there was so much to learn. They've had a 4 people management team. Okay, this was a company of about $30 odd million and 30 odd million euros in size, and 4 management, and rest was not management stuff. There was a one person finance team, but we always think about Europeans as someone who do not work hard, and they would work only from that 9:30 to 6:01. They could not be called, they could not be told anything, but they were so efficient during that period. I Just the respect for that efficiency of what they brought to the table, and learning from those as to what is it that we do. We as Indians pride ourselves working 16 hours, 18 hours a day, and still we see you have 10 people in that department, and the output is not something to be proud of. So that learning journey of being operationally involved in companies started very early for me, and that really shaped me as an investor. I started so a lot of those companies where, let's say, when I started out, when I joined Hill and Carlton in that journey, I was a junior, so you could call me an associate, manager, whatever. I was the junior person on the. But by the time Fund Two had happened, I was leading deals. I was partner on the thing. I was getting on board even as the junior person, which allowed me to kind of start developing those relationships with founders. And over a period of time, really, I think that's something that I enjoy doing the most. Some of these journeys have been phenomenal. uh, Being part of a company, when you invest in that and you see it do well, and then you exit and then it continues to do well, the joy of that, I think, is something that makes or defines you as an investor.
Okay. What is the difference between a PE and a VC? Because VCs also often own between 15 to 30% stake, what you were
Right.
owning as a PE. What
Right.
is the difference here?
Sure. So I'll tell you the difference between a PE and a VC, and also maybe later we'll bring in how Prath is different, because we think we are slightly different from what a PE does and what a VC does as well. While we are a early stage VC fund, so a private equity fund is something which invests larger amounts of money in slightly mature companies. So you're building a portfolio of companies, you're providing growth capital, or you could also be doing buyout deals and hence owning large stakes of the company, but you are actually investing growth capital. Everything is very well said. You come across a company which has reached, let's say, 100 to 500 crores in size, profitable, growing, and there are identified levers of growth, and you invest behind that. So the underlying thesis is that almost all your companies will do well. It is a matter of how much. So we would have underwritten at the time of investment 25 to 30% kind of returns in each of those companies. Some of them will deliver 5 to 10%. Some of them might over deliver and go beyond that 30%. But usually you will not see that those companies become zero. That's the core thesis of private equity. Having said that, mostly if you see private equity funds also, their returns still seem to be slightly concentrated, not very concentrated, but let's say if they have a portfolio of 10 companies, the top 4 to 5 will be delivering 80% of the return. While you will not have a lot of them become zero, but if the fund is delivering 5x or 4x or 5x, then 80% of that would have come from 4 or 5 companies, 50% of the portfolio. Whereas a venture capital is very different in nature. They're venture capital is investing in young companies. They could be large in size, but these are newer. These are bet on evolving markets or evolving technologies, and hence per se there is a high risk. Uh, they bet on companies becoming very large. So if somebody so early stage investors, when e-commerce started, somebody invested in Flipkart. At that point of time, there is not much to see around you. There is a belief that there is e-commerce which has happened in different parts of the world, and e-commerce solves for India like nothing else has solved. Like organized retail for India was not as big a solve. That's why it never became very large. Whereas e-commerce solves a lot of issues which are inherent in India related to infra and others, and hence you are taking that call coming in very early, and hence you build a portfolio of these companies. A lot of them will not do very well because by its very nature, a lot of them will take those risks which will not fructify, but the ones which do will be huge. Will have a lot of venture funds will have 100x in their portfolio, and hence the way the portfolio stacks up is very different. The kind of risk that take is very different. Eventually, I think both are underwriting to deliver returns of about 4x or 5x or at the fund level, and basically finding founders who are great. I think India and as a market is a lot founder driven. You need to find the right guys. They are running the businesses. It's far more difficult to run businesses in India, and hence those buyouts, while it started to happen, it's still very early. So mostly you're backing the right founders and taking a call on markets. These are the two broad things that investors are doing, which is being done by both P and VC guys. Just different risk appetites, and hence the return profiles are a little different.
Okay, understood. A PE typically is not looking at 100x return because
See,
the business
a
is already
100x,
mature. It's not like
yes. See, while going in, it's not, you can't see a 100x return, but you do get 100x. You do get, it might not happen. Also, it does not happen in your time frames, but outcomes of companies, there are a lot of P funded companies which have delivered 100x from the date of entry of the private equity fund. But fund, because these are mature companies, they will become 100x over a period of time which will be longer than the lifetime of the fund. So one
right.
such case for us was Safari Industries. Safari was an investment by Tano. It's a very interesting story for us as a fund. We had spent time on another brand in the travel space, and we really liked that, and we wanted to do that deal. Then we lost the deal to a peer who was willing to pay more than 2x our valuation. So we had done a lot of work. We had an investment thesis which was ready, but unfortunately, nobody was taking our money. And then on rebound, we met Sudhir, who had just acquired Safari. And I think we were so happy that other deal did not happen because instantly we loved it. Sudhir had acquired Safari as a brand, but before that, he was the professional CEO of VIP. He had spent 25 years already in the luggage space. He had
Okay.
built Aristocrat and then VIP and created a lot of value for shareholders. And also made a lot of money for himself personally. And then he got a chance to acquire a brand which was stagnant. So Safari, before he acquired it, was completely stagnant for years. It was listed for some strange reason. Even then, it was 60, 70 crores every year for the previous decade. And he acquired it, and within a year, when we were talking to him, within a year, he had taken that 60 crores to 150 crores. It was working that magic of understanding the space, attacking the low hanging fruits, and he was doing that. And we thought that there was no one in India who understood the space better than him. He was a great founder, and we backed him. And we came in when the business was 150 crores in size. We came in at a 200 crore valuation, and that business is more than 10,000 crores in valuation now. It has
Wow.
grown phenomenally, and it's been less than a decade. It's grown phenomenally. It is 1,300 crores in sales, 170 crore in PAT in the last trailing 12 months. So
Wow.
something that you and Tano obviously kept on exiting through this period, being a private equity fund, and we completely exited also 2.5 years back. Several other investors came on board, made money. For me personally, I was very closely involved with Sudhir. It's now, I think, 9 years that I've been on the board of the company. I saw as close as possible how to build a consumer business in India. Because what he bought was just a brand and the saliency of a brand which had existed for 40 years. But there was hardly anything in the company. No people, products were completely irrelevant. Maybe it was of 90s relevance of products. Distribution channels were not well developed. Supply chain was irrelevant. All of that got done, and not got done at one go, because when you're at 150 crores, you prepared for the next growth of 2x, 2.5x from there, and then you keep on building from there. So it's been, and while all of this was happening, there was a lot which was happening in the category, the consumer evolution that was happening. So it was a phenomenal journey. I continue to be on the board there now as an independent director, despite like our professional association getting on over long back. But I think these are the stories which kind of make you believe in the India consumer story even more. And I think there are many more of these that are likely to happen.
Okay. Okay. Interesting. Uh, you said that your experience of being hands-on operationally from your investment thesis, it taught you what works, what doesn't work, and therefore making better investment decisions. So, can you share what you understood about what works in India, what doesn't work, what kind of
Yeah.
businesses you backed?
So I think eventually what we are taking a call on is a market, that there is an addressable market in India which would grow at a certain percentage, and then we are taking a call on a team to say that is there a way that this team can not just grow at the market pace but outshine that growth and take a larger share of that market. And to be able to do that, I think founding team is the most important. So in private equity world, it was a team. In VC, it's mostly just the founders. At least the stage where we are coming at Prath, it's just the 2 or 3 founders were there. And while there is a team, that not really what you can take a call on. But in private equity stages, you are able to take, you have CXOs, you will have 5 or 7 people that you can see beyond the promoter, and the right word for private equity world is promoter, not founder. So yeah, so you would you have to assess the team's capability to be able to deliver what they're saying. And it's uh, what we saw, at least for private equity, was that newer for private equity to take a call on markets, new markets like really emerging, was more difficult than taking a share of a larger market, because of just getting the timing right on when the new market will see that J curve happen, when that adoption will happen at the consumer level, is always very difficult to do, and you might not be able to kind of do that in your time frame. We had an investment in a company, in a smart card printing company, in 2008, and while at that point of time it was fairly obvious that's where the market will go to, card. So it was a play on several things on the way the market was going from moving to plastic printing from paper, and all the cards that we're using from converting from dumb cards to becoming smart cards, and but it didn't happen in the time frame that one is expected, or that is expected by a private equity fund, and hence
So,
had a huge
a
impact on
smart
our
card, you
investment.
mean like a card with a RFID
With the
enabled
chip,
chip,
yeah, yes.
which you
Yeah,
can
this was
tap and
2008. This is still,
unlock
yes,
a
correct,
door or something like that? Okay.
correct. Or for payments, right?
Ah,
So
okay. Okay.
so earlier we used to have magnetic stripe based cards mostly,
Yes.
and then
Yes.
you
Yes.
had
Yes.
chip
Yes.
based cards, and cards started getting more and more smarter.
Okay. 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 Understood. Sorry. Yeah. To finish your uh, story about this
Right.
business. So,
Right. So because of us being too early in that, it was not a great outcome for us. Whereas the technology is fairly evolved. We see today there are several guys who have built more than $100 million businesses doing that same business which we had invested in. But a lot of that growth came 2015 and beyond, and it really kind of picked up pace after that. And hence private equity is, you are basically taking a large addressable market, and uh, uh, you are saying that this is a team which can deliver, and your assessment on those, on the skill sets which matter, in terms of each category is different, each industry is different. You try to assess what are the skill sets which are really important to build in this industry. And that's what you do as an investor in both, whether it's a private equity or venture. In venture, just because you are taking more bets on early, you're able to play both the new emerging trends as well, because if you're going to take 30 bets or 50 bets in those early emerging technologies, some of them will emerge faster than the others and will deliver those results. So what clearly matters is the quality of the team. And we actually, over a period of time, started putting a framework to it as to how do you evaluate. So it's difficult to kind of practice it on a daily basis. But what we do is that when we are reviewing companies and we're trying to inculcate as a system at Prath as well, that you can't come back and say that the founder was good because people, the analyst or the associate will go and meet somebody and will say it was a great founder. Okay, your grade is different from my grade. What you understand is, so we've put down lots of traits, personality traits, or things that we think are important in terms of developing the business, and said, okay, if you're going to say good, you have to say on these some of these parameters. It's not that you use all 40 parameters to evaluate everybody, but if somebody is good, he's good because he's demonstrating some of these, over index on some of these parameters. And if you say no, he was not up to it, why was he, where was he lacking in this? So all of that is happening because of the years that we have spent meeting these companies and seeing how these founders have turned out, how those stories have turned out. In my life, I've met more than 4,000 promoters, founders, and it's something that really builds a intuitive understanding of a person, and saying that, okay, I believe that this is a person who we believe can do it. But we have gone beyond saying that it's not just the intuitive or the gut that we're relying on. We put that down in a framework and evaluate that and say that, okay, this is a founder that is worth backing because it demonstrates these personality traits.
What are those traits? What all are the
Yeah.
factors in that framework? It might be proprietary, but you can give us a
No,
hint.
there is a lot which goes into it. So it's not one or two, and like I said, it's not a checklist of things in terms of people need to have everything. But this is kind of just works as something which helps us as a guidance as to, okay, is this something, so something that we really look for, let's say in Pratt, because we are investing in consumer companies, is consumer orientation, putting consumer first in your thinking. Just, is there a understanding of what consumer need are you solving, and hence why do people buy your product and your reason to exist, right? So while it's so basic, but we see a lot of the founders being so focused on just every day, this channel and my product. Just putting consumer first is something that we see daily, but we think it's is a great trait in founders. Passion for the category, right? It's very difficult being a founder. It's every day is ups and downs. If you're not passionate about the category, your reason to exist in that category has to be very clear. Why are you building in that category? Which drives the passion in that? So without that, I think it will be very difficult for people to sustain for long periods of time. You will be able to get somewhere, but then you will call into question, why are you doing this? Because it's today, at least last few years, not been easy being an early stage founder. uh, Resilience, growth mindset, uh, approach of partnership. Okay, and this is not just approach of partnership with, let's say, us, which we want to kind of have with them, but approach of partnership vis-a-vis everything. How do they approach team building? Do they approach team as partners, somebody that they're growing in, somebody who will become their shareholders in the long term? Are they okay to kind of, how do they think about ESOPs? Are they thinking about wealth creation for people who have joined them early? Domain knowledge, how do they think about that category? Because I think what is underappreciated amongst a lot of founders and also investors is each category is so different from the other, right? And people hear about growth stories, people get inspired by growth stories and try to replicate it in a different category, and it just doesn't work, right? Because what works in each category, the consumers, why you consume in category, why we buy bread versus why we buy let's say a fan, or why we buy a travel good, or why or a car. The What goes into the decision making is so different. and replicating of one versus the other is just does not. So there has to be a clear domain knowledge, which is demonstrated. Is do they come with some bit of grind in the past, right? So this is also something I think is different for us versus what we see in a lot of others, because we are not in the business of backing tech entrepreneurs, right? Consumer businesses are very different from tech businesses alone, and tech businesses get, so your profile in terms of education, IITs will get funded right out of college. They demonstrated a lot of those skills which are required for maybe building tech businesses, whereas consumer businesses needs, if you have not worked and understood what it means to build a brand, okay, and it could be maybe you were a founder and you've had a few journeys as founders, or you've worked in a company and you have in some consumer product category which has prepared you for this. But unlike, if you've not done that, I think people underestimate as to the challenges of building distribution, whether it's online or offline, building a brand. It's not just getting a product ready and going to the market, and because your product is superior, just superior product just doesn't cut it. There is just so much more that needs to be done. So I could go on. There are so many things which go into this strategic thinking. uh, while we are not investing in tech businesses, but they need to be tech savvy today. Businesses are being built digitally, right? So you need to be savvy enough. You need to understand all the tools, not just understand, but know it better than your peers, how to use those tools to develop the business. So yeah, there is, like I said, it's a lot
Okay.
of things which go into it, but some of them are just over indexed on one so much that you just feel that just this will take them there, because a lot of the other things can either be hired for, or you can most of the cases we have co-founders. So co-founders also, it's so important to understand that it can't be just they're together just for economic per se. There has to be chemistry, there has to be history between them, there has to be a common shared passion for the category, and some bit of complementary skill sets, right? I think complementary skill sets is important, but sometimes we see both of them kind of having similar skill sets, but just kind of chemistry and shared passion for the category kind of takes them there. But if there are more than one people, I think their ability to kind of do the various things which are required initially, just product, channel, consumer focus, and thinking on the brand broad vision, what are you solving? I think most of the people kind of fail to answer this question as to why do people buy their products? What is their reason to exist? Forget about the right to win. Reason to exist is something that is very important. People should know.
Okay. Okay. Interesting. Interesting. So, you know, as a PE guy who's starting a VC fund, is, I mean, it's not something which I've seen very often.
Right.
Like I've seen the reverse of a VC
Yeah.
getting into the PE space. So, what
Right.
made you want to do a VC fund next?
Right.
Once
So,
Tano
like I
was
was,
winding
yeah.
down, yeah.
So, like I was saying, I would want to make a distinction here that Prath is not a typical VC fund. And let me take you through the journey of setting up Prath. So, we decided in early 2022 at Tano that we will not do a subsequent fund. And I think of everything that I did at Tano, I genuinely enjoyed my journeys of building the consumer businesses. Seeing what really could be done, what kind of outcomes were possible. And I had also started doing a bit of early stage investing personally, and mostly all in the consumer space. Whether I was lucky or the timing was right, I was seeing phenomenal traction there as well. And validation of what I was doing through institutional investors coming in each of those companies and kind of going down the right path. So, in addition to what my personal experiences were, uh, as an investor, you're continuously seeing evolving trends. And I saw a change which was happening in India, which happens, I believe, in the evolution of all economies. And India was just going through that. I think we are entering the golden era of our economic growth, and we have possibly already entered, and we are somewhere within that. And the next 20 years, 25 years are going to be great for India, economic growth wise and consumption wise. India is a consumption driven economy. Yeah, today where we are at a per capita of somewhere around 2,500. Over the next 20 years, it's going to be $10,000 plus. And with the disparity which is there, that 2,500 today, also there are pockets can get into those details. There is that India 1, India 2, India 3 story. The India 1 clearly is north of $10,000 in per capita income. And all of these, if they quadruple over the next 20 years, as per capita income grows beyond this, a lot of that goes in discretionary spends. Today, of the overall consumer market, 30% is only discretionary spends. As this grows, the opportunity for every discretionary category is humongous. Still, we are at penetration levels in a lot of durables, which is negligible. Like, I think ACs, we are at 5% penetration, right? It's whereas I think China is already at 80% plus, right? So there is just a long way to go across categories for us in India. Then there was the two, three different modes which were there. So we had seen it was very difficult. So while we had successes in consumer businesses, it was very difficult to create consumer business in India. And it was issues were both on the supply and the demand side. Okay. Supply side, the only way to do it was to kind of have pan India traditional, the traditional distribution, the general trade, and that was pan India network creating was jobs of decades, right? Not something
Right.
that you could achieve in a few years, and hence to build a brand would take decades. And kind of just getting that presence, that's why local brands were more regional brands. They would be able to cover a particular state or a particular region, and they would kind of grow over there and reach a particular size, and then be difficult to kind of grow beyond that, right? And then there was this the taste changing. India is such a heterogeneous country. Taste changes every 100 kilometers. So how do you kind of be able to provide that in a physical world where you need inventory in those spaces, be able to provide that heterogeneity of taste and design that you need to provide to people? And then on the demand side, I think and when I was at MDI, when we were talking about MDI in the beginning, we used to read about India middle class, 300 million people. I think it was just in the strategy books. There was
Yeah.
India middle class at that point of time would have been at best a 20 million or a 30 million number, right?
Right.
Which was the consuming, which had discretionary spending power. Okay, see, income
One
does
quick
not mean,
question.
yeah.
Discretionary spend is like anything beyond roti kapra makan goes into
Absolutely, absolutely,
discretionary.
absolutely.
Okay.
Yes.
Hmm.
So just having some level of income, and we compare with purchasing power parity, and that we are purchasing power parity wise, we have so much. You need to have money to be able to spend on your wants, not just needs. And that was, I think, so small, and that was changing, right? Then digital happened, right? And digital happened, which changed the supply side. Okay, you did not need to be present everywhere physically, because you could just list on Amazon, and in a minute you're available to pan India, right? So that was a big disruptor according to me. Then on the demand side, changes happened dramatically over the last 20 years. No, and it was not just the income impact. I think there is a lot of generational impact also. Okay. People who in their 40s today have heard growing up stories about their fathers and grandfathers having seen like real difficulties and poverty in life, right? A lot of people in the 40s will have rags to riches stories. People have grown up and have had lower middle class backgrounds and grown up, whereas today's Gen Z is kind of a lot of their economic needs are taken care of, right? And hence the way they think about consumption, the way they think about spending is very different. That so the in addition to the income, this entire change in mindset of the young consumer kind of entry, there is the impact of social media. uh, I was pre internet, like I think first real exposure to internet started happening in my college days, 95 to 98, when I was at Xavier's. But today's kids are born in social media, right? They're exposed to everything, the best products and services available in the world, right? So the aspirations are that much higher, willingness to spend is higher. So that this phenomenal change which was happening on both demand and supply side, I think was really exciting to me. And I thought while there were early successes which had started to emerge, right? So this was 22, so obviously the first wave of internet driven consumer brands had already gone past 500 crores in top line, and you had to see those success stories. But my true belief is there'll be more than 500 brands in India which will do more than 500 crores in business. And it has to happen. Today, I grew up in a country which was brand starved. We are not brand starved anymore. But today, the needs of the consumer, every consumer wants brands which are personalized to them. They're getting influenced. So another big change was the ATL versus today's the way to create a brand, right? The only way to create a brand in terms of creating mass awareness was to do mass media advertising. Today, mass media advertising in a way is dead, right? You do not need to do mass media advertising, or the relevance of that to a very large extent has gone away. You do digital performance ads, you do influencer marketing, and you're able to reach to your right audience, people who are looking for your product, people who resonate with what you're building. So many changes which were kind of being driven, and I was very sure that I wanted to be part of this journey. Okay. And my the success of the early stage investing that you were seeing, the excitement of early stage investing as well, I think that journey. So in a way, while we were doing later stage investing, a lot of our successes, like Safari was 150 crores in size, 200 crore market cap when we came in. Another large success for us at Tano was the Good Glam Group, where we came in at the business plan stage. We given him, so it was not our usual style of investing, but business plan stage investing. Shilpa, I told you, was 70 crore in market cap. These were not very large businesses, neither in terms of their size nor in enterprise value. And you were taking a call on that market and founder, which is what we do at Prath as well. So 2022, when we started kind of, when we decided no, Tano will not do a third fund, and I was clear that I wanted to build in consumer. I started talking to a lot of my friends around me. I knew that I wanted to do it with someone that I had known for a long time, right? Somebody who understands investing, who I respect as an investor. So I spoke to these few people around me who had been doing this, and while I spoke with maybe 3-4 people at length, but I think my discussion with Harman right from the beginning, Harman was my partner at Prath, was, I think, we had known each other for a decade. He had had a very similar journey like mine, and he had already exited from multiples. He was at multiples for 10, 11 years. Before that, with ICICI Ventures, he used to lead consumer tech at multiples. And the reason why he had left multiples was exactly the same. He wanted to invest in early stage, and he was even more prolific investor than me in early stage. He had done far many more early stage consumer investments. They were shipping up very well, and I just felt that there was a shared passion for consumer, for early stage investing. There was this inherent trust that was there, and I think that's something that is very important in a partnership. And thirdly, I think there was this thing where I felt there is a stage of life which is relevant, and I there was it's relevant because I see in founders as well, companies that we're evaluating, and was also true for some of the discussions that were happening. Some of the other guys who were there, they were not at that stage of life where I felt that they could give it all that they had. So I feel that it's either in your 20s or in your 40s. That said, 30s you're kind of busy
Yeah,
with
true,
family,
true, true.
building family, and all of
Yeah.
that. It's while that's your prime period, but it's also a period when you get distracted by either you've got
There are
married, you've got young
competing
kids.
demands for your attention.
Yes, and you can't do that 120% going beyond, because setting up anything, we are founders, we think of ourselves as entrepreneurs, and if we do not go beyond what is required, if we do not have that passion to really drive excellence, then it's just not going to happen. uh, and hence all of these things just stacked up, and it was very clear to us that we'll build a firm which is a consumer fund. Okay. Today we are at a stage, because of the size, we are investing typically $1 million in each company, and hence these are companies at, let's say, from 25, 30 lakhs, 40 lakhs monthly revenues to 3-4 crores monthly revenues. And by virtue of that, and they're raising, let's say, anywhere between $1 to $3 million for their next level of growth. These get market defined by C, pre-series A, or series A. That's the area that we work in. But we do not kind of want to categorize us as any of that. We see ourselves as people who are helping great founders build phenomenal brands, and we're coming in at early stage of the journey. We understand this journey, having done this. Between us, we have what 40 years plus of experience, and we have been part of 20 plus consumer brand journeys, and not just from 0 to 10 or 10 to 100. Several of those companies have gone public. Several of those have created phenomenal value, 8,000, 10,000 crores in market caps and valuations. So we felt that we'll be able to bring to the table what a lot of our peers were not doing. Then another thing interesting which was happening, which is what led to our name Prath. We 2021 was a strange period, right? There was excitement beyond imagination in the early stage, and a lot of the tier one and the larger VC ecosystem got really excited about the India consumer opportunity, and a lot of money started going into consumer brands, consumer businesses, and unfortunately that was not the right match, because consumer brands don't follow the tech journey. They will not have that 10x growth year on year for a few years. They need to be built, nurtured in a very different manner. You can't expect that, okay, now we have PMF, now let's just put capital and it will grow 10x every year. That's this just the wrong approach. And because because of that frenzy, the valuations which started kind of getting for consumer brands, I think listed companies are trading at a fraction of those valuations, even sales multiple. Obviously, there was no earnings to compare with, and that created a lot of bad blood in the market. These companies which got funded, they were taken down a path which sometimes even those founders knew that this was not the right path that we are taking down. But it was growth at all costs. We have all heard that. But it was actually being practiced. We have seen that. We have seen so many companies which are trying to do down round now and really struggling, because how do you explain the last 3 years, 5 years where it's been just, you forgot about the fact that you were doing business. You just wanted to chase one number, and that sales number also gets defined differently by different people, right? Somebody is talking about GMV, somebody is talking about gross, before returns, before tax, after tax. It's just crazy. It was, but so we said, okay, in this madness, we want to come in and we want to stand for what we have always done. Money is deployed to make money, right? Everything else is ancillary. We want to have values which we bring to the table. We want to do a lot of that, but money is not invested for kind of FOMO. A lot of people around us was just not investing early. People were feeling left out, right? Something was happening. Social parties were all discussion about early stage investing, right? So we said Prath. Prath is a Sanskrit word which means value creation, also the core word for Pratham. So we said, as a first institutional investor with a focus on value creation. And value creation, when you create value, you create value for everybody, right? Those companies will create value, we will benefit, our investors will benefit. So I think a lot of this was kind of just fitting in, and which led to Prath getting formed.
You said Prath is not a PE and not a VC either.
Yeah. Yeah.
What did you mean by that?
Yeah. So I think some of this I alluded to it while talking about what was happening. So like a typical VC model is where we are saying that lot of checks. You will have several VC funds doing 40, 50 checks, where the idea is the cost of missing out on a great opportunity is much higher than making a wrong investment, right? Private equity is the exact opposite, right? You want to be absolutely sure about what you are doing. You would basically, there is a lot of rigor in your approach, in your analysis, in your thesis writing, and basically you are trying to find just those mature companies where almost everything is right, right? And you're just playing for that 25% kind of growth from there year on year to deliver returns for you. Whereas we believe what we are doing is kind of marrying both of those. We are building a concentrated portfolio. We believe consumer companies don't go bust if they're run half decently, right? They have no reason to go bust. You follow, if there is a product which is accepted, and mostly we are not coming pre-revenue stage, so there is some bit of product acceptance that one can see, and we can talk about more what that means. But there is some bit of product acceptance, and you're backing a founder who understands what it takes to grow from there. You basically keep on building levers from there, so you will take some share of the market. It if you do very well, it will be a meaningful share. You will become relevant in the category. If you don't do very well, it will be a smaller share. But it's not that you'll become zero, unlike what will happen in could happen in a lot of tech companies, right? And hence, what our portfolio will deliver, we would believe, is a 70-80% of them delivering returns to us. We might see concentration similar to private equity, where 40 to 50% will deliver most of the returns, but 70 to 80% will contribute to returns. Unlike a VC portfolio, we are, and because it's a concentrated portfolio, we are very rigorously involved with each of our companies. We are not investing in them, and then if that works out, then you kind of bring that return, which is, if you have that kind of portfolio, you basically give money to people and say that, see how it's going to span out, and then reinvest, and kind of reinvest when things start falling in place. Whereas as a consumer fund, you say these are the, you take bet on categories, you see these are the odd emerging themes, and then find the right founders within those themes, and more often than not you will see some outcome in all of them. So long as you have chosen rightly, you'll make some mistakes, and that's why you have that 10-20% of the portfolio where either your call on the category or the founder went wrong, and or both went wrong if you did a terrible job. But otherwise you have an outcome in most of them. And hence, while it's early stage investing, the the portfolio return construct starts to demonstrate closer to private equity than we see. The risk profile of these companies are very different, but obviously these are early stage companies. That there is just that risk which is there of just early stage investing, where very basic things like, and that's where we spend so much time with the founders. Will they be able to work with the team? Do they have it in them to continue for the long haul, right? Because it is a difficult job to do this for 2 years, 3 years, all of us doing the same thing. And we have so many people, so many friends around us who change jobs every year, every 2 years, every 3 years, right? People get bored by what they're doing if they're not passionate about what they're building. So if you are at it for the long haul, you have the thing to be able to build it. We believe that our model of consumer investing will deliver returns which are closer to private equity while coming in at an early stage.
Interesting. I have heard that as an asset class, private equity has the highest return of all asset classes, like public equity, venture debt, etc. Of all these asset classes, private equity delivers the highest return to an investor. Is that the case, and why is that?
So, Akshay, I don't have the exact data to be able to kind of refute or say anything in its favor, but so the way you measure returns in public markets is very simple, okay? Because it's all listed, value can be seen every minute or every day. When you do a analysis of how your portfolio is returned, that's the actual value of those. Whereas private equity returns or any private unlisted market returns are driven by, there are two broad parameters. One is the total value or the NAV, okay? Or TVPI is the term which is used, technical term. It is
Okay.
basically, you invested 100 rupees, what is that total value? And that includes what you have returned to investors, and what you have not returned, what you are holding on investments, what is the NAV of that. Okay. And that number is something, if you measure on that, I think private equity in India, at least the top quartile or the top decile, has done very well. But what has happened is that exits have been elusive in India. It's changing, it's getting better over the years, but till let's say 4 5 years back, and we had that IPO boom over the last several years. Before that, I think it was mostly returns on paper, and hence, if you talk to international investors who are investing in India, they would say all that matters, and truly all that matters, is DPI, which is what you're paying out. DPI is the money that you've returned to investors, right?
Okay.
And on that measure, I don't think private equity or venture capital scores as well as public market investing. But also, one has to understand these are very different. So one is, these are, as asset classes, very different. What in terms of just the ability to kind of, so private public market investing can be done for, let's say, short periods of time with the limited horizon. But here, just by its nature, these are very long term investing. 8 to 10 years is the kind of life of any fund. And you can't, if you're going to measure its DPI in the third year or the fourth year when the fund is still deploying, it's just incorrect. You have to look at cycles, long term cycles. And then India has not been an easy market for exits, and hence some of those, even long term, 5 year, 7 year, 10 year, also some of those periods there is underperformance private equity. But I believe that market is getting more liquid, and hence there is, and more liquid each with market getting deeper, venture capital, the Series A funds that being able to exit to Series B, Series C, and Series C kind of getting to Series D, E, and going to public market, which has started to happen. Private equity market is deepening. There are a lot of large funds in India where small funds are able to exit to. Strategic market is really opening up, especially in consumer. We see a lot of strategics being very acquisitive in nature, and hence ability to exit your companies is far more today than what it was in the past. So, I don't have the data to answer your question,
Got
but
it.
I think on a TVPI basis, definitely they have done very well. But DPI is a measure that they have to improve on. Eventually, I think it should get there.
Okay. For a private equity fund, typically, then you're saying there are three ways in which the actual money is returned to the investor. Either a bigger fund buys that shareholding, or public listing, or a strategic acquisition, which means, like,
Yes,
say, a Marico acquiring a consumer brand would be an
correct,
example of that. Okay. Okay.
correct.
Okay. Understood. You said that it doesn't make sense for a small company to have an IPO. What is the stage at which it makes sense to be publicly listed?
Actually, there is no right answer to that. Okay. And now we have that SME market as well, which has also become very large, and there's been huge number of listings over the last few years over there. But the main boards, the BSC, NSE, the main boards have still list that. Uh, so I would say that today, to get a quality investor, and that's where one has to know what is the reason why one is going public. Today there is risk capital which is available plenty for the right business, right? There is venture capital, there is private equity, there are lots of family offices deploying money. There are there are so many ways in which today a founder can raise money. India is no more a capital starved country, right? And a lot of that capital actually is domestic capital also, right? At, like, for Prath also, almost all the money that we have raised is domestic capital, and we have seen that being true for a lot of the AIFs around us. So now that you have so much capital being available, public issue, if you're going to be doing it, kind of means that you are, one is that you are going to be scrutinized on a daily basis by a large number of, you're taking public money. Okay, so there are mutual funds and the public investors which come in. So there is a concept of kind of then being on a treadmill. Quarter on quarter you have to perform, and there is a corporate governance which is expected of them. SEBI puts a very high bar on these companies, and rightfully so, of corporate governance which needs to be there. A lot of the small companies are not ready for that. They're still struggling to get their business right, and hence I believe it's an added kind of a thing. And at the same time, that public money is being put, they're trading in your shares, they're interested in how your company's market cap will increase. These are not guys who are involved in your business, right? Whereas any kind of private institutional capital will help you build the business in addition to not really measuring you on a day-to-day basis, right? So that's why the because of that, I would say that one should delay this. One should have the right reasons why you're going public. Sometimes people don't want anyone to come and be involved on the business side. They don't want private investors, and there are all kinds of people, right? What they're looking for is, okay, I'm doing well. I don't need somebody to come and tell me or guide me. I know what I'm doing. I need capital for my growth, and I need to see liquidity. I need to see market cap that gives, because private, whatever the valuation might be, it's still on paper, right? Seeing it on the exchange is very different, right? If you want to, you could sell your shares and you could realize some of that value as well as promoter, and hence those guys go there. But to to answer your question, I think to get any appetite for a market cap less than 1,000 crores will be very difficult. I've seen most of the issues starting at 2.5, 3,000 crores and going northwards from there. So it's very different from that 50, 70 crore kind of companies being listed, right? But you now have the SME market as well, which is different, which is still growing. But again, I think just in a venue for risk capital being available even for smaller companies, and there are companies with 50, 100, 150, 200 crore market cap kind of getting listed and raising capital from investors.
So
Sure.
you invested in Assembly, and people who watch Shark Tank would have seen Assembly went up against Nash and Miles. Some of your thesis would have been driven by your Safari experience as well. I'm curious to understand why you chose to invest in Assembly versus the other opportunities in this space, because there are quite a few startups in this space. from
Right.
Mokobara
So
to National Miles to,
right. So let me try to address it. So by the time they went to Shark Tank, he had already committed money, and money had not gone. So our thesis on travel goods is that India, the previous 10 to 15 years, has seen this category grow on the back of two, three broad things. One is the transition from unorganized to organized, and it was driven by a lot of things. I think just aspirations of people, as well as government kind of doing the GST and kind of becoming unsustainable for the unorganized guys to be able to compete. And so that was one big driver, unorganized to organized, and hence the mass market brands really benefited from that. So people who were at the entry price, who saw that people move from the unorganized brands to organized, just had a phenomenal decade, right? In addition to that, this category became a lifestyle category. Okay, I'll give you a personal example here. When I was growing up, I used to go to every summer vacations was at my nanny's house, right? And it used to be first day to last day. I didn't own a piece of luggage. There was no concept of owning a piece of luggage because I grew up in a joint family. You would go and ask your cousins, and you would take someone's luggage and you would take and come back and give it to them. And that's the way it used to be. I think for a lot of India. From there to kind of where that category has come now, where your travel good, and it's not just it's luggage, and luggage also the cabin luggage plus your check-in luggage, each one is different from each other. Then your backpacks have become something that you are very conscious of. Each one of us have our own, and not maybe not one but multiple. And even your kids will want to carry their own. They don't want to kind of carry your luggage. So it defines your lifestyle. Backpack, clearly it's something that you wear on your whole day, and you're very weird, again, from the generation where I used to go to college, carry a plastic thali, maybe two books in plastic thali. Today you don't see that. Today you will not even see a kind of even in tier 2, that thing about carrying everything in your backpack, right? So that entire change in category happened, and the unorganized to organized transformation happened. I believe what has to play now, which happens in host categories, is premiumization. Okay, today you have across tiers, across income classes, people having a few choices of brands. Right. Traditionally, in this, there were three large companies, and each one had multiple kind of brands. But three large companies, Samsonite, VIP, and then the third one, which emerged with that investment, was Safari, and there was hardly any new age brand till 3 4 years back. Right, these guys only between their brands which were there kind of playing this. And I thought what was happening in a lot of other lifestyle categories was starting to happen in India. Mokobara did a phenomenal job. I love that brand. They've done a phenomenal job of creating an aspirational luxury brand in the space where other luxury brands at those price points were struggling to grow. Right. For a lot of the things that we spoke about early on, in terms of the way the consumers are evolving, their needs are evolving, I think Mokobara solved for a lot of it, which the legacy brands were struggling to do, but they were doing at a very steep price point. Uh, if you ask me across categories, what Indian consumers are willing to pay for is a 20 to 50% premium, and this varies across categories, right? What when they want to buy into a better brand or something that talks to them or appeals to them, they will pay that much premium. Whereas this was more than 150% premium to the legacy brands in the mass premium space. And that's where that is one thing that we really liked about SME was the price point. We believe that the next story in travel goods is premium, and the price point where they play is the perfect price point according to us to build for the next generation of, or the next growth lever for India. Secondly, the team, the founding team, really like the two co-founders. They come with years of experience, grind that we spoke about, not domain knowledge. So one of the founders is part of family which manufactures one of the largest manufacturers of third-party manufacturers of luggage for several brands, and hence there is a this is a business which requires you to have product knowledge and very deep supply chain knowledge. So that was something which was a huge differentiating factor for them, and they had built this business very frugally. So, sure, we have seen more than 1,000 companies now in the 16 odd months that we've been evaluating companies, and capital efficiency in most companies is like 1.5x, 2x, which is measured as what their current run rate is divided by total capital which is gone in the business. And a lot of them are less than 1x. A lot of them very big brands. I don't want to name them, but they're brands that we really like. But the capital efficiency is very low because the amount of money which has gone in creating the brand awareness or just creating the top of the funnel is so high. They have their capital efficiency was more than 5x, and we
Wow.
it was really different from a lot of others. The frugality and having come from family business, understanding the importance not just of unit economics but the burn with which you build a business. I think a lot of these things really differentiated them. And we really, I think it's sometimes just the chemistry. You met them, we loved it. Mukubara was well past us, our stage by then. And a lot of the others we met, I think almost everybody in the space that were raising money. There was, I think we liked them the best amongst everyone else.
Okay, interesting. And what about Jimmy cocktails? The Jimmy's cocktails. What was the thesis
So
there?
so Jimmy's, so you would see a common thing that we have a very strong founder market fit in for all our three investments which we have completed. So Jimmy's started by Ankur and Nitin, and both of them have 20 years experience before this in beverages, most of them. So Ankur has had multiple experiences, but a large part of that was where he launched Jim Beam in India, and he'd spent 10 years there with Beam Suntory and the alcoholic beverages side. So understanding of the category was very high. Nitin, on the other hand, had spent 20 years in distribution, FMCG distribution, the previous 10 years with Red Bull North India distribution. So non-alcoholic beverages distribution, Ankur, alcoholic beverages, marketing. So it was kind of very, very strong market fit, which we saw. Great founders had kind of built the category. So we were speaking a little bit earlier about large category versus small emerging categories. I think our when we think about it is at a fund, we want to invest across both because we are a uh, long-term fund. We have the ability to be able to sustain for that period of time for even these emerging consumer trends to become large and meaningful. So Jimmy started as a mixers brand. So in India, alcohol can only be sold through those wine shops, and hence pre-mixed does not work in India because then you have to sell only at that wine shop. To be able to sell across the grocery stores or modern retail or online, uh, they came up with these mixers. So you mix your alcohol and have that drink at home, and that they are the category leaders by far. The next guy is like 1/5 their size, and the brand, they've done a phenomenal job. There is such a high. So India one, the top end of the India one, there is just unbelievable that I don't think I come across people who have not heard of that brand or not consumed that brand. So it's great job on the brand, on product, phenomenal team, category creation. But while it is category creation, we know that mixers per se cannot be your Jacob immediately. You have to wait for that to happen. Ankur tells this far more brilliantly than I do in terms of what the opportunities and what it can become. But I think the idea was that they have the capability to become premium beverages brands in India, which caters to a lot of opportunities. So Jimmy's has been taken to a lot of adjacent categories after we invested. They've launched tonic water, they've launched some of the other sodas, and now 6 months back they've entered into energy drink as well. Energy drink is unlike the mixers market, is a very large high growth market, and been kind of amongst the beverages, all beverages put together, the star in terms of the category in India and even globally. It is it's something for Gen Z. The caffeine kick kind of comes in far better as an energy drink than what tea was for our generation, right?
Yeah,
Is
right.
what energy drink is for them, right? They
Right.
it is a functional drink that way, right? So it's not just something that you have to have a good time. It's something that gives you that caffeine kick, and something that people kind of really want in their daily lives. And unlike mixer, which is an occasional drink, this is an everyday drink. And they were very clear, and with Nitin's experience of doing distribution of Red Bull, they wanted to build this for a not the metro or tier 1 but a tier 2 audience, a market where so India, Red Bull is a very large outcome. It's at a 125 rupee price point. Plus, they built a very aspirational, phenomenal product. Then you have Sting at the other end at 20 rupee price point. It's the largest success story in India in terms of beverages. So they are building at a 60 rupee price point where they're building a great product. Again, they do a phenomenal job on product and branding and building an aspirational product at 60 rupees in tier 2 where the consumer cannot have Red Bull every day, while aspirationally he might want to have Red Bull. So if he wants to drink energy drink every day, he might there might be occasions when he is going out and with his friends, he will show that he'll have Red Bull. But for everyday drink consumption, hustle is not. So it's I think it's still early days. We're very confident that they'll do a great job there. So yeah, that's our thesis at Jimmy's.
Okay. Okay. Let me end by asking you this. For people who want to build a career in PE/VC space, what's your advice to them? How does one go about building a career here?
So for the longest period, I've told people that one should kind of have more experience on the sell side, try and understand businesses, try to get the rigor of what it takes to kind of understand businesses, do 2 hours of 2 years of rigor in investment banking or research before you start thinking on my side. But even if let's say somebody is starting out and we have hired a fresher as well, and I think there are a few things which are very important. I think curiosity is extremely important in our business. You need to ask questions. Our business, you need to understand businesses, and it happens over a period of time. Uh, I have gray hair and I've seen 4,000 businesses in my life. I will be able to come up to the curve faster than someone else, not because I'm smarter, but I just have had that much more experience. I keep saying it to my team, no question is the wrong question. Mostly, actually, you get the smartest answer for the dumbest questions because you don't know. You ask a dumb question, it leads to some discussion which is very meaningful, and you try to understand something that possibly I would not have asked for, thinking, oh, I know this, but somebody will ask it and it leads to that. So, curiosity, willingness to kind of really so private equity venture capital business is a self-starter business. Okay, so while I'm an entrepreneur now, I believe that I behave like an entrepreneur always. Right? If you're not self-motivated, then it's not a business for you because these are very small teams. It's not like working in a bank where you will have somebody telling you morning में और शाम को check करेगा कर लिया ना. You're given enough freedom to do your thing because that's the way most of the private equity firms are. They're between 5 to 10 people teams, and they want each person to be self-motivated to really excel, to go out there and wanting to make a difference. When you want to be a better person every day, you will contribute towards the firm as well. And that's what, if you don't have a growth mindset, you can't contribute towards the firm. So having a growth mindset and curiosity are two like big things. If you have this, you should, there is, unlike when we were growing up, everything is available. Read, there is just so much to be read. There is follow. If people say that we want to be private equity investors, they don't know anything about private equity. I think just be genuine, show what your interest is. If you are passionate about something, it's far easier today to follow your passion wherever you are. You don't have to be in that business to kind of do that. You can follow what's happening across the world and demonstrate. You can. So I remember public market also, when somebody say that I want to be a public market investor. Public market investing is very easy, right? You make a portfolio of 1,000 rupees, or you start a demat account, 1,000 rupees, start demonstrating you're a public market investor. Similarly, I think private is also getting there where so much information is available. Demonstrate that you understand this. Say that okay, you can't buy those companies because you're not available, but say that what are the ideas that look good to you, demonstrate. And I think people don't find shortcuts. I think there is if it is not for you, it's not for you. It is a lot of hard work. It is more of, I think it looks great from outside. You're on the buy side, you work in a PVC firm. It's a lot of hard work being on PVC, and one should be ready for that.
Uh, I- so you probably would know, like, say, Fireside team has a lot of Unilever guys who set that up. So is that also a way to enter this, like from an operator to an investor?
Yeah, I think there are multiple ways that you can do this. There is no right way. I think India is such a large opportunity, and there are various ways to address this. I think while operating is one way where you're able to understand what really your ability to guide them on that growth path will be much higher. I think investing is a slightly different skill set, but I think all of Kawal is
You
a
can
great
learn
guy.
it
He's
is
been in
what.
investing, and he has been investing for a long period of time, right? So so investing, both the skill sets. So operating is something that I learned by working with these companies over a long period of time. I have been an investor for much longer than that, and you need to understand both the skill sets. Unlike in public market investing, where you just select and you have to time your entry and exit, you need to understand trends. In private equity and venture capital, you need to be able to do both, because there is a lot of value add or the value creation which is driven by what happens after investing. So selection is extremely important. You need to have your themes right, you need to find the right people, but what you do with them post investing, how you behave with them, what leads to also leads to a large part of value creation, and hence both are important. And that's why people can have both ways of kind of doing this. It's different in terms of data globally. It's different in terms of operator run VCs have not really had great outcomes, but I think India market is unique in every way. I just feel that at least in consumer funds, there is just so few of them addressing the early stage consumer opportunity, and there's so many guys who are trying to build good businesses. Uh, there is space for 5, 10 guys to come and thrive.
Are you as hands on with your portfolio companies as you were during the PE days?
Absolutely. I speak
Okay.
with them very often. They've become great friends, and we add. So the requirements are also slightly more or slightly different. Where there is at a very early stage, it's just kind of helping them through several agencies on several fronts. They're looking, let's say, on performance marketing, on fulfillment, on let's say branding. You're helping them, and it's so for us, we don't just say, okay, this is the introduction, and we would want to some of those, because they are very critical in the way that they will kind of shape the company. You get involved, not just introduce, ensure that, make 3 introductions, make sure those 3 conversations get concluded, and then be involved at the early part of that journey till we feel that it's got into a stage where the company can take on from there. Hiring is one area that we really work with a lot of them. These are, so again, because of their size, they're not looking to hire like really, they can't afford the tier one guys. They're not able to, or also they can't have a very large organization. So identifying first what is the critical role for the next 6 to 12 months, and which will take them to the next stage, and then they can add more, I think is also a very important thing that we do with the companies. And some of this we start even before the money is gone in, kind of building out the org structure, realizing, okay, these are the critical gaps, and how do you think about each one of those. So a lot of the companies that we've invested in, the CXOs would get salaries which are higher than the founder salaries. So
Yeah.
that founder
Yeah.
mindset also needs to be clear that, okay, I am taking the large risk. I'll get that reward. These guys, what is their reward? Even if I give them 1-2% ESOPs, that doesn't kind of really solve it for them, and might
True.
not be driver enough for them to move. So hiring a lot of these agencies, kind of just basic kind of thinking. uh, we keep telling our portfolio companies to do the right thing even if it's hard, and we practice that. We want all of our companies to practice that. We know businesses are not made on Excel sheets. None of them fail on Excel sheet, right? Have you seen a
Yeah.
business which fails on Excel sheet? So it's real life, right? You'll have challenges which are more and different than what you anticipated, but don't hide bad news. Okay, say bad news first, share bad news even before you feel the need to share good news, because we believe we are partners. Okay? We truly believes the moment we invest in a company, we are shareholders, we are partners. We are not someone who will just ask good and difficult questions. We are somebody who will ask those questions, will lead to how do we solve those problems, because asking questions after so many years, or is very easy for a lot of people to do, but uh, how do you solve them is what, and that will only happen when you know the bad news. People, I've seen a lot of people have this tendency of kind of holding back bad news, hoping that things
Right.
will change, I will not have to share it.
Yeah. Yeah.
That's what starts most of the bad episodes, the way companies kind of do. So hopefully we'll be able to inculcate this in our entire portfolio. But the idea is that you become partners on day one. uh, just make sure that they understand that we know there will be good days and bad days. We are there for the long term, and we'll help them overcome the bad days. So that's a general philosophy, and helping them through this period, becoming someone who they can call on, they can speak to as a friend. I think it really helps developing that personal equation with the founder, so he doesn't feel the need to they know that, okay, I call him, he's not going, what there, why are you this bad day? they no you I think as an investor you have to be like a sponge. You have to be able to absorb that. If you're not able to do that, Akshay, I think you will, without knowing it, you might say this as lip service, but if you can't absorb bad news and you are going to give it back to them, you will see that that wall which gets created, and that's what creates a lot of problems. Because if you
Right.
don't know the problem, how will you solve it? How will you try to attack
Mm,
it
mm.
in any way? Yeah.
It sounds a lot like bringing up a child.
Yeah, it is not very different.
Yeah. Okay, cool. Amazing. Thank you so much for your time, Piyush.
Thanks, Akshay, lovely talking to you.